In the last week of FY 2022, two reports regarding the Indian economy came. The first one was from brokerage firm Emkay Global, which expected Nifty to reach 19,000. The second report was from the domestic rating agency ICRA, which cut the growth forecast from 8% to 7.2% for FY 2022-23. If these two reports looks contrasting, then let's look at the past performance of the market. Last fiscal year began with a second COVID wave, while it ended with the geopolitical tensions, hike in interest rates, rise in crude oil and metal prices. But even after all these headwinds, the share market gave good returns in FY 2022. During this time, the share market reached a record high. Nifty gave 19% and Sensex gave 18% annual return. During this time, investors' wealth increased by 59.75 lakh crore rupees. During this period, the market cap of all the companies listed on BSE increased by 29%. It stood at over 265 lakh crore rupees. Due to these record valuations, foreign portfolio investors have made massive profit bookings. In 12 months, they withdrew 2.1 lakh crore rupees from the Indian market. So, will the market give a similar return even this year? Times are tough at the start of FY 2023. On one hand, we have the Russia-Ukraine war, high oil prices, rise in commodity prices, while on the other hand, rupee is becoming weaker and interest rates are increasing. These factors will put pressure on the company's profit margins in the next quarters. So if the prices rise above a certain level, then demand will fall, which will impact the economic growth. ICRA stated in its report that Russia-Ukraine war, rise in commodity and fuel prices can impact domestic demand. Now, let us look at the picture behind Emkay's report. Because you might also be thinking that if the economy is not expected to perform well, then how can we have a bull run in the market? Actually, in the total profit of Nifty, 70% share comes from just 4 sectors: bank, oil and gas, IT services and metal and mining. Besides banks, earnings of the other 3 sectors are expected to increase, because commodity prices are rising and the rupee is getting weaker. These sectors are export oriented. Brokerage house Emkay Global said in its report that in FY 2022, Nifty profit after tax can increase by 1,80,200 crore rupees to reach at 6,04,800 crore rupees. Companies like JSW Steel, Reliance Industries, ONGC, SBI and Airtel will lead this increase. 2/3 contribution in the PAT growth of Nifty 50 will come from these companies. So in FY 2023, PAT of Nifty 50 can increase by 1,24,600 crore rupees to reach 7,29,400 crore rupees. Siddharth Kemka, Vice President and Retail Research Head, Motilal Oswal Financial Services says that pace of FPI outflows has decreased. Besides this, growth has been slow on a higher base. There will be value-based buying opportunities in FMCG and IT sector companies. These sectors have continuously performed well. After aggressive selling during the recent time in the banking sector, you can also invest there. Due to all this, there can be a positive FPI trend. But their level of buying will depend on the war, commodity prices, and how the situation will emerge regarding inflation. Money9 suggests. So in the current times, Money9 suggests that you stick with your investment and invest in sectors like IT, which are not directly impacted by rising crude oil and commodity prices.